Are you a scaling SaaS founder?
Ready to make the leap from leading a team to leading an organization? Join us each week as we refill your think tank with actionable tips and strategies from great business minds you know and those you don't know yet. This is SaaS Fuel with your host, 5-time entrepreneur, SaaS founder, and globetrotting adventurer, Jeff Maines.
Welcome back to the SaaS Fuel podcast, where creating wealth is like baking a giant pie. And the more we share, the sweeter life becomes. I'm your host, Jeff Maines. I hope B2B SaaS founders like you grow from traction to scale. Here, growth is more than just numbers. It's about crafting a future-proof company, premium valuation, and leaders who build a business of significance while living epic, adventurous lives. Fear is the greatest enemy of success. Think back. Think about a time when fear held you back from achieving something significant. What did that cost you? You got it? Fear is often the biggest obstacles leaders face, and myself included. Our greatest success is often just on the other side of that fear. But to get there, we have to overcome it. We have to move through it. We have to move past it. So you ready to turn your fear into fuel for success? All right, let's do it. Well, fear is a powerful force that can paralyze decision making, hinder growth, and limit potential. And as leaders, fear can creep in at the most critical moments, whether it's making a bold decision, pursuing a new opportunity, or standing out for something you believe in. This fear can manifest in many ways and creates barriers that prevent you from reaching your full potential. It's essential to recognize fear and understand how they're holding you back. But the crazy thing is often we attribute it to something else. Oh, no, it's not fear. It's analysis. It's procrastination. I'm looking for consensus. I want to hear from my team. It's risk avoidance. I don't want to take a big risk. Or, hey, it's lack of ambition. I don't really need that. That's not really for me. Not a big deal. But to conquer it, we have to be real. We have to know the enemy. We have to call it out and take steps to lead with confidence. If we're going to call it like it is, what kind of fears do we deal with as leaders? I think the first one is fear of failure. This is a big one. It's fear that can stop you from taking risk or trying new things. And leaders often fear failing in front of their teams or stakeholders or their family. And it leads to a preference for safe, but often potentially, we'll say, stagnant decisions or no decision at all. So, we don't take those steps because we're afraid. Well, we'll say it's something else. The second is fear of rejection. And this is some leaders, it kind of depends on background. If it's a sales background, maybe we're a little bit past that. But I don't think any of us are ever all the way past that. It's the fear of not being accepted or valued. And that can prevent us as leaders from voicing our innovative ideas or making unconventional choices. As founders, sometimes we do want to blaze our own trail, but do we do that always? Do we really push past that? Fear can stifle creativity and hinder progress. Another one is fear of the unknown. It's the uncertainty of the future. Leaders can hesitate to pursue new opportunities because they're unsure of the outcome. And it leads to missed chances for growth. And I think about fear of the unknown, and a lot of you guys know I scuba dive a lot. And there's a lot of unknowns in scuba diving, whether it's jumping into water you've never seen before, maybe, looking down into the abyss where you can't see the bottom, or even, descending or ascending, you can't see the bottom, you can't see the top. It's nothing but blue water and, what's out there. Or sometimes what's out there. It's, we do a lot of shark dives and photography. There's nothing between you and sharks but a camera. And so you're pushing them away. But it's really, how do you get past that fear? And maybe it's a little bit crazy, but I remember that the first time I did a shark dive, and it was really just figuring out how do we do this? How do I stay calm? How to just be chill? And this is where there's sharks with bait in the water and some other things, and photography and videos and stuff. So it was planned that way. It wasn't just like a chance encounter. But how do you remain calm when there's a lot of craziness going on around you? But it's that fear of the unknown, of jumping in the water anyway, or jumping from a high dive. There's so many different ways we can do that. Just the fear of the unknown. Another one is fear of loss. And this really involves, potential loss. It could be reputation, resources, position. And as leaders, it can make us overly cautious. We can be really resistant to change and even afraid to invest. Afraid of losing what they have. Whether it's, you grow a business, for example, you exit, make some wealth. Does that make fear go away? Hey, or maybe you get a funding round. No, I think, the fear is probably 10x when you have something. Because if you don't have anything, you don't worry about losing it. Not a big deal. But when you have something big, then I think that fear is a lot bigger. I mean, you know, fear of failure or fear of unknown. I think are big ones, but fear of loss, that may be the biggest one of all. That one, that's a monster, but it's okay. We slay monsters. Cool. The other one I thought about is the fear of missing out, FOMO. And leaders can really feel compelled to pursue every opportunity, especially early on, because we're afraid that we'll miss the important one, the crucial one. And I've missed lots of deals before, and I've got some really interesting stories about that. Uh, but that can really lead to burnout. It can lead to a lack of focus. It can lead to just second guessing yourself all the time. What if I miss out on this one if we don't do it? But my number one tip for overcoming fear as a leader is to build resilience through courage and support. You've probably heard the saying, fear is like an acronym, false evidence appearing real. Yeah, I looked to see who that was attributed to. The earliest one that I could find, the earliest one I know, is Zig Ziglar. And there maybe somebody else said it, but I've heard it from lots and lots of different sources, attributed to all sorts of places. But false evidence appearing real, and the thing is, it's not real. It's evidence. It looks like something is there, but it's not real. But here's the thing: fear is a liar. It's not real. It's a shadow. And resilience is like a muscle, and we have to build it over time. It's not something that we can just take our biggest fear and just go conquer it tomorrow. It takes small steps. So it's pushing past one and another and another. And what we do is we start stacking wins together, and you stack win after win after win after win, and then those big things look a lot smaller. It's a lot easier because you have that confidence. It's embracing the mindset that failure is not the end. And I don't even like the word failure. It's a learning opportunity. But when we have those moments, and it can really feel like failure, it's not the end, but it's a stepping stone to success. We learn something new. So how do we build that resilience? Surround yourself with a supportive network of mentors, peers, and advisors who can provide guidance and encouragement. And we need that so much. Practice self-reflection, mindfulness to understand and manage your fears. Look at that false evidence and go, no, that's not real. Fear is a liar. I'm pushing past this. And remember that every great leader has faced fear. But what sets them apart when we think of them as great leaders is their ability to push through it and keep moving forward. Now, conquering fear is essential for achieving success by facing and overcoming your fears, jumping in the water, facing those sharks, looking into the abyss and saying, I own you. You unlock your true potential and transform challenges into opportunities. Embrace fear as a catalyst for growth and lead with courage and confidence. Our founder on Tuesday was Amarpreet Kalkat, founder of Humantic AI. We talked about AI in sales, building trust, connecting with buyers, and structured sales methodology. Our expert guest last week was Jordan Burton, co-founder of Talgo. And we talked about building amazing cohesive teams, and it all starts with good sourcing, flawless interviewing, and finding the right match for your company, which may be different than somebody else's. So how can you hire with confidence? Go listen to that episode. If you missed either one of those, go back and give them a listen. Good stuff there. My guest today is JP Albano, co-founder and CEO of Significant Lifestyle Communities. They're managing over 60 million in assets. JP, with a 20-year career in IT, including a decade in B2B enterprise sales, where he sold over 220 million, JP shifted gears in 2017 to invest in multifamily apartments. He is the best-selling author of So Rich You Can Quit, a guide for leaders building and growing wealth through passive investments. Welcome, JP Albano. Hey, JP, welcome to SaaS Fuel.
I'm so excited to be here, Jeff.
Well, you were in a successful tech career, 220 million in tech sales, and transitioned into real estate investing. What inspired the transition and how did that journey unfold?
Yeah, it's not that I'm going to say a long story, but there were some steps along the way, right? So being in tech sales, finding success in that, it was tech sales was almost an accident for me. I was an engineer. The sales guy that I covered left. The company was like, "Hey, can you cover these accounts till we find someone to replace him?" Sure, no problem. Well, turns out not so bad at sales. So
That's good.
that worked out pretty good for a number of years. And I got to a point where I was starting to get the itch of like, all right, I think I've learned what I can in this role of, really want something else. And then I realized no matter where I go, because I was making a good income, I'm very thankful for that. I felt like I was going to start all over again, right? So I realized there's a term for that. It's called golden handcuffs. I had golden handcuffs. I couldn't go anywhere.
Yeah.
Then I'm like, all right, well, I don't want to keep selling hard drives for the rest of my life. Well, what am I going to do? And I'm like, well, I need to make passive income. And I realized I was also paying a lot of money in taxes, another good problem to have. And I did some research, realized capital gains income, right, from passive income, like from stock markets, things like that, or real estate, are taxed at a low rate. All right, cool. I'm going to do that. So I decided to become a day trader, and I took a course, learned how to read candlestick charts, lost a bunch of money, and realized I hate day trading, man. It's a lot of stress. I wanted really, but it led me to realizing what I wanted was optionality. I wanted the freedom to choose. The joke I say is like, if I want to do pottery on Tuesday at 3 p.m., I want that kind of flexibility. And so what it uncovered for me was like, oh my God, like passive income, real estate gives you passive income. And the next problem you have is in real estate, there's a lot of different ways that you can do real estate, right? You can do
Yes.
industrial, you can do retail, you can do fix and flips, a whole bunch of stuff. And for me, I found apartments. Apartments just made, and still does, all the sense in the world to me. And so that was how I got started in the path to apartment real estate, and ended up building a business and all those things. But that was the journey from sales to to real estate.
That's awesome.
Yeah,
Kind of the same thing. Got into real estate early on. It was more about wealth preservation
yeah,
and just continuing income. So exactly what you said. It's that passive income.
yeah, yeah.
And when you first started, you started with single family rentals. And what were some key lessons from that experience that shaped your approach to apartment syndication?
Good question. And it was interesting. I think it's interesting because I've had bought into the idea of apartments, like apartments. That makes all the sense. And then I got my partner at the time. He's still a friend, Tyson. We kind of got distracted with like, because apartments, you don't just get one overnight. Like it takes a lot of time. There's a lot of learning. There's a lot of things
Right.
to it. At least that's what I told myself, and it's still true. But buying a single family rental is relatively easy compared to the complexity of an apartment complex, right? So
Sure.
I let myself get distracted with like this opportunity to for the three of us, me, Tyson, and another friend. We each bought a house in Midland, Texas. A guy had a leg up on the market there. If you don't know anything about Midland, Texas, it's a very boom and bust city.
That's where I grew
One
up.
day it is exploding, literally exploding. I mean, not in a literally bad, but like economically, right? This total boom.
Right.
And then the next day, it could just be on a bust, right? Depending on oil prices. And
Yep.
so we saw an opportunity to make some money. So we each bought a house, and I got stuck with the house with the bad renter. Deshaun is
Oh,
his name.
wow.
Deshaun and his girlfriend. And God bless their soul, man. They really got me good. So not pay, choosing to pay rent this month, next month, pay some here, pay some there, and I had like I had a soft heart, so I would like let them go, and they were completely taking advantage of me. So I learned a lot of lessons, and it really underscored like why I liked apartments so much. And I want to make this like a rah for apartments, but like when you look at the two options here, with a single family, you have really one source of income coming in that we use as the landlord to pay the mortgage, right? The whole idea of this is kind of build equity, right? They're paying down the
Right.
mortgage, they're paying down the principal, and they're building equity for you. But if you have one source coming in and they lose their job, they get sick, they get divorced. By the way, all those things happened to me as a landlord in that house. Then guess who's paying the bill? This guy, right?
That's
In this
you.
case.
Yep.
And so it really just, it's very easy to destroy whatever potential profits you are going to make or passive income that you were relying on to establish your lifestyle. And so like that, I think it was a good distraction because it really underscored like, man, I want the diversity or diversification or risk diversification of multifamily, of 2, 10, 20, 200, 300 people, units, paying the rent each month that I can apply towards the mortgage. So that's there was a lot of lessons there, man.
Oh, absolutely. And I found that the same thing. I think that's one of the ways that the people go wrong when they get
Yeah,
into it is they
yeah,
just buy one. And I started with
Yes.
3 and then,
Yep.
grew from there. And, once you have, 5 or 10 or 20, then, a vacancy here or there is not a big deal because the rest of them take care of it. And that's kind of what you have in the apartments world is where
Exactly.
you have that diversification of risk, which is really, really helpful.
And then the other side is an element of economies of scale, right? So depending on the
Yes.
apartment complex, I have one of the second properties we bought was two. It's a 12 unit, but it's two 6 unit buildings, and so in each of those buildings, I have 2 roofs. So that's great. Like if I can have one building with 6 renters in there, or 8 or 10 or whatever, that's one set of roofs that I need to worry about, right?
Right.
Um, and there is economy of scale with respect to like wear and tear and expenses that can save you versus the
Absolutely.
alternative of having a dozen homes, single family homes. I mean, yeah, you can do that, and you can scale a bit slower and easier in that scale, right? But like then you've got the counter side of like, wow, I've got 12 roofs. I have to make sure that there is not a hail damaged storm thing. That happened to me too, right?
Exactly.
But I think to your point you were trying to make is I think some people maybe don't imagine realize that, right, going into it. But that is
Right.
something you should be aware of.
And it's important, just like you said, there's a lot of ways to do it.
Yeah.
And there are a million ways
There's,
to
yeah.
invest in real estate.
Yeah.
And we've talked about 2, and there are probably 25 more we could list
Absolutely.
off.
Absolutely.
And so,
Absolutely.
just that it's really about opening your eyes and just thinking, what is out there in the world. And I love what you're doing, especially around the apartments.
Well,
And the difference between active investing and passive investing. A lot of
that
people
was
think that,
literally where I
single
was going to go next, Jeff, is bringing
yes,
that up,
yeah.
right? Active versus passive. And I wanted to ask you, when you got into your houses, right? Were you looking at that as a way of, did you realize that was going to be an active investment, right? Like you're the landlord, right? The buck stops with you, whether you have property management or not, right? Or were you considering that to be passive when you first got into it?
Yeah, when I first got into it, I didn't even ask the question. It was just like this this is kind of the thing to do, and this is a way
Yeah,
to build more wealth and
right.
preserve and have a return. And it's just not one of those thoughts that happen until significantly later.
Yeah,
And I started doing commercials, started doing apartments, and it's like, oh, this is much easier. This truly is passive.
it is passive.
I,
Yeah.
I don't do anything. And
Yeah.
so it was a very, very different mindset, a few years in versus the beginning where I thought this is just what you're supposed to do. But there was a lot more out there that I didn't know.
You know what's interesting is it's like everyone sort of that gets into real estate eventually makes that realization. And there's
Yes.
2 sides to it. There is this side of like, I didn't know, so I got into it and then I realized, oh my God, this is a lot of work, right? So there's that part. And then there's the
Yeah.
apprehension like, no, 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 no. Nothing is passive. This sounds too good to be true, right? Like I need to deal with tenant toilets and trash. And so when you present an opportunity to be a passive investor where you're a silent partner, right? You're a limited partner, and your only role is providing capital for the opportunity here, and then someone else is running it. Like the extent of your responsibilities is like signing paperwork and depositing checks. That's truly it when you are a passive investor. And it's amusing to just see people kind of experience both sides of that.
Yes. Yes. Yeah. Passive is by far the better route. Just because I don't have any responsibilities, I don't have to think about it, and it's just like you said. I mean, I get a check. It's like magic, and then we sell and we do another deal,
Yeah,
and then the cycle starts all over again.
yeah, yeah,
So
yeah.
it's been an absolute blessing to move into that instead of what we used to do.
Amen. Amen.
So why do you primarily focus on real estate deals in specific markets? A lot of times you said that the Southeast is a focus. What makes one market attractive versus other ones?
Yeah. So we when I first got into real estate, I as an engineer, by trade, if you will, very analytical mind. And when I got into apartments, one of the first books I read was a book by Dave Lindahl called Emerging Markets. And I read it from cover to cover in one session because I love the idea that Dave pointed out like there's ways you can mitigate risk and with an investment, right? Like, so what is the product? The product is an apartment. Okay. Okay. Who's the market? Renters. So how do you ensure that you have a virtually unlimited amount of renters in that marketplace? Well, turns out if you invest where people are moving to, that's one way of ensuring that
Yep.
you're going to have a big pool. Looking at places where there's job growth, population growth, because job push really drives population growth. I love the idea of landlord-friendly states as opposed to tenant-friendly states.
Oh,
And when you're
yes.
a business owner, you want to invest in a landlord-friendly state. If you don't like business and you want to run out of business, then you invest in tenant-friendly states. So those three things: population growth, job growth, and landlord-friendly states. It narrowed down when you look at the map. It actually turns out the Southeast, this is back in 2017 or so, was the places where things, and there are other parts in the country too, but for the most part, it's the sunshine states, the smile states, as they
Sure.
call it. Because look at a map, it's all the Arizona, Texas, the whole southern part there. And so I did some research, and there's a study that comes out by the Urban Land Institute, ULI. It's like a 300-page document, and I went through that thing for like a month, and I sorted the list by basically like affordability of these top markets. And by affordability, in my mind, I was looking at like what apartment units are the cheapest for me to get into with respect to having to raise money for. Right, I think Dallas was number one at the time. And Atlanta was towards the bottom of the list. I'm like, let's just do Atlanta. So I made Atlanta my primary market. And so, but it was because of those reasons. It's because I want to find ways on how to mitigate risk. And that's what really any good investor should do, is understand there's always risk involved, right? But like,
Right.
how can I mitigate as much as I can? Because you can't control everything. As much as I can, these things that I can't control. And you can't control where you buy. You can control where you're investing. And if you want to invest in a place, I don't want to throw Detroit under the bus, but let's just say Detroit's population is declining. I think it has been for many, many years. But like Detroit versus a market where there's like over the last 5 or 10 years is a long-term trend of population growth. That's, a healthier, safer investment.
And that makes a lot of sense. And those numbers are pretty easy to find. You can see where people are moving from, where they're moving to. And that's what you want, is you want that flow of people.
It's
That's what
super easy.
keeps
If you type in on Google, right, you type in like a city name or a state population, like literally the result will show you a graph over the last 10 years, and it's either going in the right direction or going in the wrong direction. And as long as you're investing in places where it's going in the right direction, like you're taking a big step towards ensuring that you're mitigating risk, that you've got a good buyer, a renter pool. At least we're talking about multifamily, right? Other types of assets have different sort of criteria, but this is not rocket science.
Right. And I think all the more reason to look at passive investments rather than active, because it gives you more market flexibility. It's very difficult to manage rentals long term or long distance.
Yes.
And I've seen people try and do that. They'll move away or buy something that's far away from them, and nightmare to manage. But you look at something that truly is passive, and that really gives you a lot more flexibility in where you can invest.
Well, could I expand on that for a second? So like one thing I run into a lot of times, and not a lot of times, every once in a while you run into an investor where they're open to the idea of investing, but they have this hang up, and maybe you've seen this too, Jeff. This, we'll call it a hang up about like, no, if I'm going to make an investment, I need to be able to see it, touch it, right?
Yes.
Like I'm going to give you the money. But like it doesn't extend to other things. Like when they invest in Coca-Cola stock, like do they go to where the Coca-Cola is made to go see it, or like doesn't really work that way. So I think for some investors, you got to remember, depending on where you live, like I lived in New Jersey at the time when I got into this, I realized pretty quickly, New Jersey wasn't the place for me to make those multifamily investments because of affordability, because of the macroeconomic trends. There were other markets. And so I had to get comfortable with the idea that, okay, I'm not going to be close by 2, 3, 4 hours. No, it was a plane ride. And so I think it's just like, be aware of that. Like if you're thinking about becoming an investor, you're going to be passive, you're going to have no control over the deal. There are probably better, safer opportunities for you outside of where you currently live. And if you're going to be active, it's a different story, right? That's a whole other thing in itself. But as a passive investor, like it's okay to not it opens up the world of options for you when you are comfortable with investing outside of your local city. Would you agree?
Yes. Oh, absolutely.
Yeah.
Your city is one small, part of the entire world.
Yes.
And, there are definitely returns in every market. No doubt about that.
Yes.
Some of them are harder to find than others, but they're definitely there. But if you expand that out to the entire country, or even international investments, the opportunities are astronomical.
I'll add one other thing to that, Jeff. So like people need to keep in mind too, and it's like, we all have short-term memory sometimes because the brain forgets pain. But like in real estate especially, everything is cyclical. right? And so,
Yes.
but what's cool about this is the cycle, it's on so many different scales. It's on the micro scale in your neighborhood. It's on the slightly larger macro scale of your zip code, of your city, of your town, of your state, of the country. And
Yep.
all of these are going, they're in different parts of the, you can see me on the video here. I'm moving my hand up and down on the cycle. And so like there's bigger picture macro cycles that are going on and smaller ones. And just because in your neighborhood it might seem like things are down and depressing, somewhere else they're on the upswing. I've been to certain parts of Texas, Houston. Houston's blowing
Yes.
up now. I was there last summer, and it is exploding. Whereas about a couple of years prior to that, it was going well, but not nearly as much as it's going now. So, like, I think it's important for people to be aware of.
Yeah, that is important, and also to keep in mind that everything goes up and everything goes down. So there are those cycles,
Yeah.
and there are ways to make money if the market goes up, if it goes
Yep.
down, if it goes
Yep.
sideways.
Exactly. Exactly. Yeah. There are strategies for where you are at certain parts of the cycle, and just being aware of that is half the battle.
Yes, absolutely. Well, returns are something that people are always interested in, and your goal is to double investors' money every 3 to 5 years. Walk us through that. What are our typical returns that you see? Obviously, returns are not guaranteed,
Yes.
but
Past performance
what?
is not indicative of future, whatever. Right.
Correct, correct. We're not giving investment advice here, but tell us a little bit about returns and the strategies that you use to get returns for your investors.
Yeah. So it starts really with like having it starts with the asset class, right? So like, we like apartments because in the grand scheme of lots of real estate, really any investment, like it's generally considered lower risk compared to other things. A lot of people will be like, "Oh, I can invest in this new startup," and the returns are like 60x. Sure, but it's a much riskier thing, right? So real estate really scratches the boxes, being able to make a safe investment in something that's tangible. There's the value of the land, the value of the building, or if all things kind of go to crap. So there's kind of that part. And then kind of universally, we'll say that in apartments or multifamily, generally speaking, there's like an industry rule of thumb. Most apartment deals that are value add, and I'll break them down. There's what are called like stabilized or brand new apartment complexes. Those returns are usually lower compared to the ones that you just mentioned. The ones you mentioned is usually what I like to work on, which are called value add. So we're forcing appreciation. We're buying a property, usually older, built in the 80s, 90s, 2000s. It's funny to think 2000s is old now, but it is. It's 20
I
years
was
old.
thinking the same thing. It's like, hey, that's
Right?
not old. Wait a
It's not
second.
old, but it is actually 20 years is a long time. So these are
It is.
properties that they need some kind of renovation. We upgrade the kitchens, and we know we can charge a little bit more in rents. Okay, so by doing that, we're increasing the bottom line, the profitability of the property. And in commercial real estate, that's how things are valued. So the bank will give you a new loan based on the new value you've created. So that's called value add. So for value add deals, typically speaking, the returns are between 15 and 18-ish% average annual return. I'm not going to get into IRRs. That's a complicated thing. But just like, hey, look, if I give you 100 grand, what does that look like? It looks like $15,000 to $18,000 on average each year, right? Usually looking back when the project's done. So it doesn't mean you make $15,000 year one. Usually you're spending a lot of time, energy, and effort repositioning the property. You're investing capital to make the repairs. So the first couple of years are usually low as far as like cash returns, but they usually get caught up towards the end of the life cycle. So that's in that year 3 to 5 range. And of course, it always depends on the market condition. This is a great example because, as of this recording in 24, springtime of 24, we went from a seller's market in multifamily over the last number of years, meaning like if you were a seller, you can command your price, and buyers were just like foaming at the mouth and teeth to get deals.
Right.
But now that interest rates have shifted and they're higher, the cost of capital is higher, and that's completely changed the market, like seemingly overnight, and it actually felt like it was overnight, where now it's more of a buyer's market. Sellers aren't able to get the price they want. So now buyers can negotiate much harder, and we're seeing things at a big discount, 20-30%. So my point here I want to make is that 3 to 5 year timeline, we talked about everything's a cycle, depending on where that asset is located and where it's in its market cycle. That 3 to 5 year timeline could be now, which is not a good time to sell. So you might have to hold it until it is the right time, because otherwise you're taking a haircut for the sake of taking a haircut. So
Right.
hopefully that wasn't too much, but that's generally what we're looking at. 15 to 18% average annual is usually, boilerplate normal returns. And I think you asked me how we do it. Did I answer that?
Yes. Yes. Go ahead. Ready to dominate your market and skyrocket your revenue? Dive into Small Fish, Big Pond, building a world class business that swims circles around competitors. This book is packed with powerful marketing and leadership insights, guaranteed to transform your business and operate world class. Small Fish, Big Pond delivers powerful strategies to sharpen your marketing message, deliver unmatched value to your clients, and guide your prospects' buying journey to one inevitable conclusion. That is that your company is the only solution for them. Inside, you'll find step by step frameworks and time tested growth principles to attract your ideal clients, convert them, and then turn them into your passionate brand ambassadors. Get your copy today in print, ebook, or audio at smallfishbigpond.com or on Amazon. Plus, remember, every book sale supports charity. All profits go there. So dive in and make a difference.
No, I think that was it. We like to force appreciation. The other thing that we do now is a little different. I'll add, Jeff, is so we still look for our own deals because we operate our own apartment complexes. But over the last 6 months or so, we started doing something differently. We've taken our expertise as operators that have run our own deals and bought our own deals and sold our own deals, and act almost as we'll call them fund managers, right? And so we work with our investors, we work with other best in class sponsors that are maybe experts in self storage or mobile home parks or other large apartment complexes, and we allocate capital with them. So we become passive investors alongside our other investors. And to your point, or our points earlier, it's much easier, right? Like someone else is now dealing with the tenant soils and trash, and we're passive investors. So our job is basically like do the screening, the due diligence, look at the deals, try to find really good deals, and vet them. So it's been fun.
I like that.
Yeah.
Well, you mentioned interest rates. I know that's something that a lot of people have, seen happen in the market. A lot of our listeners are founders, leading companies, and the cost of capital is significantly more than it was a couple of years ago. How has that affected the real estate markets, and what do you see going forward? Now, obviously, if you're having to sell at a discount, it's not as liquid as maybe you would like it to be. I mean, that's just the nature of real estate investing, is it's not liquid.
Yep.
But how has that affected timelines and horizons? If you buy something, and you had a 3-year time horizon, what happens?
Yeah. So, I can talk from personal experience. We bought a deal in 22, kind of right at the end of things, kind of bad timing. Bought a deal in 22. We were looking to do our refinance in 23, 24. And that was 23, 24 is when all interest rates were going nuts, in an unprecedented manner. And what that did for us was when interest rates go up, I'll get a little advanced here, but it's not super advanced, but no one can follow. So what happens in real estate, things are kind of valued using what's called a cap rate or capitalization rate. Cap rate basically is a way of saying, if I buy this thing in cash, what is the average annual return it's going to spit out? And there's a relationship with interest rates and cap rates, and it's inverse. So as interest rates are low, interest rates are low, cap rates are kind of low. Actually, no, I guess it's directly proportional in this instance.
Yes.
So when interest rates went up, cap rates increased, and the reason why that matters is there's an inverse relationship with the value. And I'm not getting super complicated here. Basically, what it means is when cap rates are really low, the valuations of the business, every dollar that the business makes is worth a lot more. It's not a 1-to-1 relationship. It could be like 1 to 20.
Right.
It's like an X multiplier sort of thing. Okay, but when cap rates go up, then that changes. You get closer and closer to $1 equals $1. And that sort of sucks because you want that leverage to create that value for investors. And that's how people have made so much money over time. But so the last couple of years with interest rates going up, cap rates have gone up. And so when you would try to do a refinance like we wanted to do, we were trying to get to a valuation of $17 million, but we didn't get that. We got to a valuation of $15 million. That's a lot of $1 million that are missing between the two.
That is.
So it creates problems for us. We have to do cash in refinances. It's just not a good time to do that. So that's how things affect it. But now on the other side, if you're a buyer, because the cost of capital is higher, right? And because it's now a buyer's market, we're seeing discounts across the board. 15, 20, 25% over what prices were just a few years ago. And
Yeah.
I know from my research that in a handful of like top markets like Phoenix, Dallas, Houston, great markets where there's strong demographics going on, strong trends. There's a lot of apartment owners that were just like me that bought properties, in the last couple of years. Their loans will be coming due, between now and the next 2-3 years. And because of where interest rates are, they will be mathematically unable to qualify for a loan. So they'll be kind of forced to exit. So what I'm getting at here in a long-winded way is it's creating an incredible purchasing opportunity for
Yes.
investors. So, I talked to some investors and there's like the sentiment, like, I don't know, interest rates are high. It's expensive to buy a house. I feel like now is not a good time. Right. And sure, maybe on the residential side, but on the commercial real estate side, it is, I don't want to say a buying opportunity of a lifetime, but it's one of these things where like, this is where you make a lot of money. And I think if people can understand that, they would be more comfortable with taking advantage of the opportunity, because that's what it is. It's an opportunity, and it's not going to be here forever, a couple of years. And if you can buy right at those spots, that's where you make your money, right, Jeff? You make it at the purchase. So you're
That's right. You make money when you buy.
exactly.
100%.
So that's what I'm seeing, and that's how interest rates are affecting things, both sides of the equation there.
Yeah, I like that. And right now, it is absolutely a buyer's market, and there's so many good deals available.
Yeah.
And I think that will continue, but for the reasons that you said.
Yep.
There was a time horizon, and people bought it at times, and either they can't refi, they can't hold on, and they got to sell, and that is creating a lot of opportunities.
What's interesting too is going back to earlier, we talked about cycles. Is like, excuse me, none of this matters if you're not selling. So if there's no reason for you to sell, your note isn't due or your loan isn't due, and you've got a 10-year loan and you got it in 22 or 21, you've got 10 years. There's nothing forcing you to exit. So you weather the storm until the market shifts from a buyer's market to a seller's market. And then suddenly, oh, good, market conditions change. There's a lot of people that are looking for deals. And now I can command my premium for my asset. And that's how you do this. It's a longer game.
Yeah. And just like what we were saying, you make money when you buy, and when you buy right, and you do have the time horizon, then it gives you options, and you can, hold on.
Yeah.
And so you're not forced to sell at a certain point. So you have an opportunity to hold on and wait, or, some people, may want to cash out, and you can, buy them out.
Yeah.
So there's a lot of other things that can happen even inside of a deal.
That's right.
For our audience, they may be not as familiar with apartment investing. Can you break down kind of the mechanics of how a typical deal is structured? And, what is it? Do we all just go, buy an apartment together, or explain how this works in limited partnerships?
It's funny. Everything's funny. When I got into this, everything is like this mystical, complicated thing. Every aspect. At first, you're like, all right, I like the idea of buying an apartment, right? I have 12 units. They make this much rent. Here's my expenses. That's it. No. And then enter the world of syndication, where like legal paperwork and SEC and different types of investors, and it's insane. So usually most apartment real estate, there's a couple ways I can describe this. Simplistic. Jeff and I decide we're going to be partners. We're going to buy an apartment complex. Cool. We're both managers. That's it. We both have responsibility. We both sign on the loan. Cut and dry, easy. Okay. There's no super complicated things with that. You have an attorney draft up an operating agreement. We explain our responsibilities. That's it. Right. Okay. Now, for what we're talking about, where active investors, passive investors, that's where things become a little bit more complicated, but not super complicated. There's basically two roles, two classes, if you will. There's the general partners, the GPs, as that's called, and then the LPs, the limited partners. So in this example, Jeff and I would be the GPs. We are the ones that are running the deal. We're operating it. We're dealing with the day-to-day, tenants, toilets, and trash. And the passive investors, right? The LPs, the limited partners, they're the ones, their only contribution really is to provide cash for the endeavor. That's kind of really it. and we take care of the day to day. They're responsible for receiving the financial benefits. That's the most simplistic way that you kind of do things. And usually you wrap this is called a syndication. Syndication is where we're doing this. We create an operating agreement. We have these classes of investors, active investors and passive investors. We work with an SEC attorney. They drafted the paperwork. And usually there is a breakdown of how we're going to handle the economics, how we're going to handle the payments. So as this project makes money, usually LP investors, passive investors, they're paid first. That's generally how most syndications do it. They pay your investors first. There's some number, it could be 7, 8, 9%. It depends on the deal and the risk factor of it. So they get paid first. And the ones that are running the deal, Jeff and I in this example, we don't usually see any money until after those investors reach that return number, whatever it is. And then after they hit that number, then we split some cash a little bit. And there could be multiple versions of that, but to keep things simple, that's usually how it's done. And what this does is it incentivizes Jeff and I to do a really good job because we don't see a penny. We work for free until we get to that hurdle. And then after that, that's when we get to participate and we get to share in some of the profits there. And the alternative is if we got paid first, then investors don't get paid and then it's a little weird. So like this mechanism, it helps to align the interests for all parties, align the interest of the passive investors to reward them, right, for investing in the project. And then it aligns to motivate Jeff and I to do a kick butt job and really crush it so that we can participate in some of the financials there.
It's a really good model, in my opinion. And mostly what I do today is the limited partners. And so I've got a company that specifically does real estate investing, that manages those investments, that is the limited partner in those deals. And it's been really, really good because it is passive. And you're exactly right. The active managers, they really have an incentive to do good and get good returns for the investors because that's how they make money.
Yeah. And I want to be not more clear, but let me add one other thing too. So, because what I don't want to have happen is if people, their first time hearing about this, they're like, oh, that's how Jeff and I get paid. That's not 100% true. We do charge fees. Well, usually we charge fees, right, as a GP.
There's a management fee typically.
There's a management fee.
Like property management. Yeah.
And there might even be an acquisition fee. And I want to like that should be encouraged because one of the mistakes I made early on, we got our first large property was a 278 unit apartment complex in Cleveland. And the bank wouldn't let us take our it was a $17 million deal. They wouldn't let us take a $180,000 acquisition fee. And that really hurt us because that money we were counting on to invest in additional human resources in our business. Like, my partner, Matt, and I, we want to run the business, but we don't want to be the guys in the business, right? Like we want to have teams doing this.
Makes sense.
And so by not having access to that cash for the fee that we would get when we close the deal, that hurt us from being able to invest in our team until much, much later on. And so it ultimately hurt the project. So the point I want to make here is, when you're looking at an investment, you want to understand the fees that the sponsors are getting paid, and see and making sure that's in alignment with everyone's best interest, right? The sponsor shouldn't, usually they're using that money to invest in the business and invest in the resources so that they can keep the machine going because this is a 3 to 5+ year commitment, right? Like, you don't want to run out of cash to keep the lights on. Like you don't want your sponsor stressing out and having to manage 5 deals like literally on their own. That's not how you build a scalable business. So I wanted to add that, get on my soapbox, talk about that.
That makes sense. Yeah, you definitely want to take care of the managers because they're the ones that are making you money. And so you want to make sure that they're well taken care of and incentivized and everybody's goals are aligned.
Exactly.
Yeah. Well, some of the best deals out there are not necessarily on the market. So it's not like you just go and you find things that are for sale and buy them. How do you source off-market exclusive deals? And what advantages do you see for those deals compared to the ones that are just listed or out there on the open market?
Yeah, there's couple elements to that. So there's like at a certain scale, some of the smaller multifamily deals, and by smaller, I mean what, sub 50 units ish. It depends on the market. You might find them on an online website like LoopNet, right? Like it's the Zillow for commercial real estate, right? So you can find those things, and usually the running gag is they've been picked through before, right? It's where deals go to die, sort of thing. But you can find deals on there, or at least get in touch with a broker who has other deals that aren't on LoopNet, right? That's one way that you can do that. The other way, really on the larger scale, is through broker relationships. And fortunately, unfortunately, they take time to season and develop. And so once you've closed some deals with a broker, it builds trust, and they're looking for certainty of close so that when they recommend a buyer for the seller, they can, yep, I've worked with JP before. He's a good guy. He can close the deal, and there's that certainty of close, and then you're more likely to get the contract. So that's kind of one part of it. But the other part where we've kind of shifted a little bit, where we're kind of doing this like scouting out for deals, we're leveraging our tenure, our experience in the commercial real estate market, in our networks and the relationships that we have with other best-in-class sponsors. And so we've created a platform of a beacon, if you will, where it's a relatively one-stop shop where a sponsor can come to us and talk to a handful of other fund managers and be able to write a much larger check than any one investor can. So for example, these deals that we do, they might require $3 to $10 million of equity to come in. So they need to, these sponsors have to talk to, and usually the average investment from investors are like 100K. So if you're raising $8 million and your investor average investment is 100K, it's a lot of investors you got to talk to. It's a lot.
Yeah.
So if you can talk to a group and that group can bring in $2-3 million or so for you, that takes care of a big chunk. And it's like one person you're talking to or two people you're talking to. So much easier. So we're getting a lot of traction from sponsors. And because of this supply and demand here, we're able to be much more choosy with who we're working with. We want to make sure that they've got a great track record. And the deal is exciting, right? Because we want to mitigate risk. So we want to make sure there's a good story behind there. And that's how we do that. So it's shifted a little bit, but to answer your question, it's the combination of broker relationships, and depending on deal size, you can look on LoopNet for some things, or it's just getting to a point where you can command a larger check. And so as a result, you're more sought after than most regular single investors. And the last point I'll mention too is this: our investors, they benefit because usually to get the same economic terms that $1 million investor is going to do, you got to put $1 million in. But if you're going to put in 50K or 100K, you can get pretty close to those economics without having to put in 10 times the amount, right? So that's nice too.
Yes, absolutely. That's the greatest success. It's probably a group of maybe 15 people that are kind of in the group.
Yeah.
And in any given deal, there are probably 6 or 8 of us in there. And it's exactly what you're talking about. It's too big for the small investor, and it's too small for the giant corporations to care about. And there's that sweet spot right
We're
there in the
Goldilocks zone.
Yeah, absolutely. And it's a great place to be.
Yeah, it is.
So the investors that you work with, they have to be accredited investors, or is this open to other people that are not necessarily accredited?
Yes, currently we are only working with accredited investors. I was talking to a friend yesterday about that. We might change it in the future, but right now, to get things started, it's accredited investors. It's a little bit easier. They understand things a bit more, and we'll work with that. We might open it up in the near future.
And if somebody doesn't know what that is, we'll link it in the show notes, or you can Google it. Accredited investors. It's just specifically some qualifications in order to do some investments like this.
Yeah, it's simple.
Yeah. One of the things that really surprised me early on in getting into real estate investing, one, capital gains taxes are still outstanding for long-term capital gains. Some of the best rates out there for tax rates. But there's another thing that I learned, and that is that when you sell, you have 2 options. One, you can pay taxes, or you can buy more real estate. Like, no, wait a second, I can do that. And so 1031 exchange, have done that for 20 years, over and over and over again. But there's some complexities to that. How do you navigate the complexities, especially when you have multiple investors involved?
This is where I say I'm not an attorney. The 1030. So wait, a question though. So have you literally rolled like your first deal 1031 20 years? Like, is it been going, or you've done?
No, not all of them. Not all of them. So
Okay.
there have been some that have done that. Some have gone ahead and just sold and taken it off and done something else, or it went beyond the 90 days, and then we didn't find something until 6 months later. You have to buy right.
Exactly. So yeah, 1031, it's like the IRS gives you this thing like, hey man, we can just defer those taxes. But there's a lot of crap, a lot of hurdles that you got to jump through. And they're not a lot, but it can be a lot when it's a seller's market and you're trying to, so basically what you have to do is it's a like for like exchange, right? So when you buy,
Right.
you can't sell an apartment complex and buy a car wash or
Right.
self-storage. It's got to be another. And usually you're moving up. So you sell a 12 unit and you go into a 20 unit. Cool, right? And then
Correct.
it's
Bigger and better.
bigger and better. And it's brilliant, right? Like how you can save that potentially up to 20%, which is still better than most other tax rates for active income or ordinary income. But being able to roll that in, it's like an extra 20% bump you got for equity that you can put as a down payment for another project. So it's fantastic for really accelerating how you can grow wealth and grow your portfolio. Yeah, you have, you said it's 6 months once you have 6 months to acquire a replacement for it. If you can't do it in that 6 months and you have like 90 days to identify the asset, then you got to close on it. So it creates a lot of stress for everyone involved when you're doing the
Yes.
1031.
Yeah, it's difficult to do.
We haven't, except we had some 1031 investors that had $500,000, $1 million to put into a project. It gets complicated because they have to be on title. You've got to do either a tenants in common, TIC, or there's another one that you do as far as the corporate org structure that your attorney will help draft. But it's one of those things where my mind went numb in listening to how it needed to get done. So I might not
You
be the
definitely want somebody else to help with that. It's not something you just do on
bottom
your
line
own.
here is if you're in a 1031 exchange, you work with a 1031 attorney and you work through it.
Yeah.
There's things to, the takeaway is you don't just like, that's it, we'll find something. There's things. Talk to an attorney because there's stuff. But we do work with some investors. Some of the sponsors will accept 1031 money, but generally speaking, they won't do it unless it's a substantial amount. And substantial amount probably is a minimum of $500,000. So if you've got $500,000 or more of 1031, we're able to help investors put that into another passive deal. But otherwise, it can be tricky.
Yeah. Well, there are other tax advantages as well. So what other tax advantages do you see as a real estate investor?
So I see two. One is the fact that you're shifting your income from, if you're an employee, right? Your W-2 active ordinary income is potentially taxed at the highest rate that there is. And depending on where you are in that tax bracket, you could be paying up to 37% of your taxes, federal taxes for that. Plus you add state and other things. And before you know it, half of your check is gone. Ask me how I know. So then the other world is capital gains, and capital gains is graduated as well. Could be zero, but the max is 20%, if I remember correctly, and it's kind of graduated there. So 20% is a heck of a lot better than 37%, right? It's almost 50% better in that regard, roughly. And so there's that piece, and then there's a whole host of beautiful tax programs that are available for you to minimize how much other taxes you're paying on that source of income. We talked about 1031. That's one of them. The other one is being able to do various levels of depreciation. So depreciation is one of these things that I didn't really know about until you get into real estate. But basically what it means is the IRS allows you to write off the fact that you've got this building, okay, and every day it's decaying. You can't see it because it's going very, very slowly, but it's falling apart. And so they allow you over the period of 27 and a half years, 30 years, what was round up 30 years. 30 years to write off the purchase price and as a loss on your taxes. So any money you make, take the purchase price divided by 30. I'm doing simple math here. And each year you're able to write that off. So if you make some money, let's say you make $5,000 in actual profit that year, but it worked out that your loss was $5,000. So you're effectively paying taxes on $0. Cool. You actually brought home $5,000, but they're allowing you to do the depreciation on that. That's great. Well, a lot of years ago, there was the Jobs Act, I think, from Obama. Jobs Act allowed investors to pull in that 30 years of depreciation down to the first couple of years. And it was called accelerated and bonus depreciation. So you could take the 30 years and pull it in. Basically what it means is you put $100K into a deal. You wouldn't be surprised if you found that you're able to write off 100% or more of that cash investment as a loss. As an investor, if all of your income is passive income, then you're starting at negative $100,000. So you got to make that much money before they start counting how much taxes you were paying on your first dollar. Hopefully that made sense. And so for a lot of investors that are high income, the depreciation that you get from passive income from investing in real estate is huge because they got to dig themselves out of that paper hole, or hole on paper, I should say. And so it's not uncommon to pay very little to no taxes on any of your passive income that you make. Now, obviously, talk to your CPA, talk to your accountant, but that's how it works. And that's why the wealthy favor real estate so much, is because of how the tax law is created to incentivize real estate investing, real estate, and things like that.
Yeah. Oh, absolutely. Tax advantages and just leverage. It's something where you're borrowing, 70% or so on the asset, and you're getting a return on 100%. So there's some great leverage on the capital invested as well. That's one of the reasons that you get really good returns, plus the tax advantages.
Yep.
Well, looking ahead, what trends do you foresee in the real estate market? And you said, it's always going in cycles. And how are you positioning your investments to capitalize on the trends?
So I mentioned some of this earlier on. We were talking about the cycles and buying opportunity, right? Like right now, my research is showing me that it's really a great time to have access to cash, dry powder, for deals, right? Because most deals on the market, they're already at a 15, 20, 25+% discount from where they were a couple of years ago.
Yeah.
It is harder to get loans on that. So the cash equity needed to, get deals is a bit more, but that kind of balances out because interest rates are higher. So the loan that you're going to pay on that money is going to be more expensive. So maybe you're better off putting some more cash in there, a little lower leverage. That's okay. That's being prudent. So there's that part. And then really, in between 24 and 26, there will be a lot of loans. What's the number? It'll be a few thousand. I think the number was like between 5 and 8,000 assets that are projected to not be able to qualify for a takeout loan or a refinance during that time window. And these assets are located in prime markets across the U.S. So being able to have cash available to jump in to buy these assets from distressed situations really creates a phenomenal wealth building opportunity. So what we plan on doing is continue to grow out our investor list, identify investors that want to be notified when we find these sort of assets. And then for us to continue to grow our network of other sponsors that have their finger in the pulse with the brokers, with those local markets, waiting for those opportunities. We've already worked with some on some distressed seller situations where they're buying the thing from a distressed seller. They need to get out, and that's how we're getting at a great basis. So we're just going to plan to continue doing that over the next few years until that window closes.
That makes a lot of sense.
Yeah.
Well, where can people learn more about you online?
So you can check me out on LinkedIn. I'm JP Albano, but I just wrote a book. It's right behind me. So Rich You Can Quit. So you can check me out on sorichyyoucanquit.com, and you can access the book, the audio book, all the things on the website.
Outstanding. We'll make sure and link that in the show notes. JP, great conversation. Thanks for being on SaaS Fuel.
Jeff, thank you so much for having me. I too enjoyed the conversation. This was great.
Thanks again, JP, for coming on the show and sharing your insights and resources. You can learn more about JP and wealth strategies over at thetechsalesinvestor.com. As always, all links, highlights, resources, and full show notes are available at saasfuel.com. And of course, check out our YouTube channel as well. Full episodes, video shorts, training, and outtakes, because, we mess up all the time around here. That leaders share. So share this episode with somebody who could use a little confidence boost. Send it over and tell them you believe in them. Everyone who shares this week gets some leadership boots of butt kicking. These high-tech boots give you a literal spring in your step, kick fear in the face, leap over obstacles, and wade through all the bureaucratic BS in the business world in style. Join us next Tuesday, where our founder is Glenn Paul, president of Dot Photo. They specialize in enhancing customer experiences through technology and personalized products. And next week, we have a super special episode. It is number 200. Episode 200. I'm doing something I've never done before, and that is we have a repeat guest. And it's a very special guest, a great friend, He was also my very first guest, Neil Gordon. He's absolutely brilliant in episode number 1. If you missed episode number 1, you go back and give that a listen. He was great. I had no idea what I was doing. So maybe I'm a little bit better now, 200 episodes later. Maybe not. Who knows? But he was so good. And he is now back with even more. And this time we're talking about using storytelling in your marketing. It is going to be epic. Every time I talk to Neil, he's always got great things and he will absolutely bring it. So I will see you next time. And as always, enjoy the journey.
Thanks for listening to SaaS Fuel. Full show notes for each episode, which includes a summary, key takeaways, quotes, and any resources mentioned, are available at saasfuel.com. Be sure to follow and subscribe wherever you listen to podcasts. And if you're enjoying the content and getting value from these episodes, please leave us a rating and review at ratethispodcast.com/SaaSFuel. We'll be sure to read these out on future episodes.